Good afternoon, everyone. This is Sam Agresti with Brady Ware Dealership Advisors doing our December and final 2019 webinar. This month, we're going to do a year in review, kind of wrapping up the key takeaways. We've had a nice series of webinars this past year, and we're going to do a flyover and hit some of the key takeaway and points over each of those webinars and try to bring it all together as we wrap up 2019. So with that in mind, we'll start with the first. Our first one in the beginning of the year was dealing with managing interest rate exposure. Most dealers have floor plans and other term debt related, and it's amazing what changes in a whole year. As we started the year, we just came through 4 rate increases by the Fed, where they've kind of pumped the brakes on the economy a lot in 2018. As we sit here in 2019, we see a whole different stance coming out of the Fed, which is a more accommodative Fed this year, with a few, 2 or 3 rate decreases actually. So it's kind of reversal by the Fed as we saw. So it's kind of interesting when we did that webinar back at the beginning of the year, we were looking at increasing interest rate exposure and strategies. However, it's still very important to kind of still consider your interest rate exposure. I mean, when you look at that, you look at some of your fixed debt, interest rate debt versus variable, and some of the strategies we discussed at the beginning of the year are still fairly relevant, even though we've seen a reversal by the Fed and a kind of a stance where we're probably going to be in this low interest rate environment for near future. I think if you look globally at the globe, the main currencies, the United States is still one of the safe haven currencies out there compared to Germany, Japan, which are still in a negative interest rate environment. So we still expect, especially last week, Jerome Powell came out and kind of gave it an accommodative stance and doesn't expect any future rate decreases, but will still probably be in an accommodative mode, which means we don't expect any interest rate increases. But like I said, some of the strategies we discussed with fixing some of your variable debt, such as your floor plan, using rate swap strategies and other derivatives, we feel are still kind of relevant. And that was really some of the stuff we talked about in our webinar earlier this year on managing interest rate exposure. As you know, when the rates do move up, it could have a $200,000 to $300,000 change in your bottom line. So it's really important to kind of still keep an eye on it and not take your eye off the ball with it. These are very historical low interest rates. Fixing a portion of your debt now still makes a lot of sense. And I think that's, quite frankly, we've seen it in the car sales. Low interest rate environment and low fuel prices have really fueled car sales here too as well. So I think it's still very important to manage your interest rate exposure. Then we went into your digital empire, having a digital ground game. This is something we believe very strongly at Brady Ware. We invested in a joint venture to perform digital empire. We think that the digital ground game of a dealership is very important. The sales, as we all know, probably in this webinar, the sales process is changing continually, where the lot ups, the way people search and buy cars have changed, and have a strong digital presence is very important. Having said that, as you all know, you probably have 3 or 4 calls a week from people providing this service, and there's a glutton of third-party services coming at you every time, and we just really strongly urge having a sound plan written down, sticking to it, and not chasing the new shiny penny every other month. A lot of these plans take a few months to get underway, and you really don't see results, sometimes for 60 to 90 days. So building that, that's one of the things we talked about in that webinar. Justin Ward, who's our own digital consultant, really works with dealers and kind of mapping out that strategy. This is something I really strongly consider as in early 2020, before the selling season really kicks in, is getting that strategy laid out and integrating it with the traditional marketing stuff. As we know, sometimes those car ups never show up on the lot because they can't find it they don't see you don't have a strong digital presence. So we really feel that's an important part, and that's something we talked about in our webinar that month. And I really direct you, as I hit all these points, is to go back to those webinars. They're on our website, and I'll say that again as we wrap up. So for more detail on that, the presentations from those individual webinars are on the website. So But I think those are some of the key takeaways there was, understanding the marketplace, what you're selling, analyzing and building the digital strategy customized to your store. So if you're a heavy truck, if you're pushing heavy trucks versus a market versus sedans or cars or a mix, emphasize that, make sure your digital strategy truly reflects that. We see websites that still have Mercury on there and stuff that's been long gone. So it's amazing what you see when you start looking at some of these websites. And then lastly, stick to the plan. Don't go out chasing the shiny penny and changing every other month. So then we had another area we feel very strong about. We did a webinar on fixed operations efficiency. Our own Brett Coker, who does a lot of fixed operation consulting, we really put this on, and he along with us really feel how fixed operations is a vital part of the dealership. It covers, especially if things when they do get soft, having a strong fixed operations is what sells your dealership through those rough times. And a lot of dealerships focus always front end, and it's often the fixed operations is a second thought. So some of the things he talked about during that webinar that we felt was very important is understanding your KPIs. He talked a lot about retention, recruitment, and grow your own and build proficiency. All those things. Techs are a scarce commodity right now. So recruiting them, training them, and retaining them is very critical to your operation. Also building proficiency, making sure the techs are proficient during turn to flat rate hours. All these things add up to your KPIs, and monitoring those KPIs monthly and kind of managing to those analytics will really see the results in your bottom line of your store. So that's something and Brett does a lot of training on that, working with the service advisors to identify opportunities and converting those into flat rate hour sales. As you know, the fixed operations has not just the franchise dealers, but also the independent dealers that are on this webinar as well. This applies to them as well. So having a good fixed operations, like I said, is something that will keep you through the next soft times when the economy gets a little soft. And then we went to a DMS comparison. We had Sandy Jerome, who does a great job, and we consult with her a lot of times when we get into DMS considerations. As you know, that's been a major expense, and it affects every area of the dealership. Over recent years, it used to be when you had the ADP, which is now CDK, Reynolds, and the two main ones. And now you have some of the second tier ones, dealerships. There's a lot of considerations when that contract comes up that can really save your dealership. But you got to really do a needs analysis to understand that DMS, and you're utilizing DMS fits your store. And that's something Sandy does a lot of, and she gave us a lot of good insight that month about choosing the right DMS system, and especially some of the different choices out there now with DealerTrack, CDK, Reynolds, Dealer Star, which is Sandy works a lot with. And there's some key factors, especially when you're reviewing those contracts that you're locked into, what's all involved, the hidden cost in those contracts, understanding that. Also, understanding the report writer capabilities, what kind of reports. So one of the things we see a lot of is these DMS systems have some really powerful features, some of them, and they're not underutilized. So maximizing what you get out of there to operate your business is critical, and training your people in those areas. Then we flipped over to the next expensive thing for dealers is the facility upgrades. So that's when you get the friendly letter from the manufacturer saying they're starting an image program, and either that, or it might be just the time when you do a ground up build out of a new store. So there's a lot of things. We used our friends from Rainier came in and talked to us about that in our webinar, and Bill Heifner, who's the president of Rainier, does a lot of the construction of the dealership buildings, and some of the pushback and negotiations that you can do with the manufacturer regarding a facilities upgrade. These are huge capital outlays, especially a build up brand new store. It could easily be the $4 to $5 million in cost there by the time you put the land and all the construction costs. And they do it a little differently, which I think it makes a lot of sense to us, is the design and build concept versus design, bid, and build, where they integrate it and it's an open book and you really understand your cost in doing so, especially on some of the bigger projects. You really don't want to get hit with a bunch of change orders towards the end or unexpected costs. So that's that's why we really advocate this design and build concept. The Rainier really does really well. But again, there's a lot of negotiations to take in with the manufacturer on that, because these are huge capital outlays, especially on the remodels. So something to really consider and take your time and look at, make sure it's the right fit for the store and the market, and work with the manufacturer on that. Then we got to reinsurance operations, and most dealers have a reinsurance program of some sort. And understanding what the reinsurance is, we had our friends from Protective come in to talk to us about that. There's different kinds of programs, and really understanding what program you have there's different programs, and make sure you're understanding which one you have, and know if it fits what you're trying to accomplish is really important in this area. The reinsurance contractor create a lot of, doing the reinsurance probably could gives you a lot of ability to grow wealth, and you got to make sure that the fees and the tax efficiency of the plan fits what you're trying to do. A lot of times we go into stores and it's we see it and they really don't have the training going on with their F&I people. They're not really maximizing the reinsurance program, and that's something that you really want to be considered. Basically, you have the retro programs, the controlled foreign corporations, the non-controlled foreign corporations, and a DOWC, which is one we really advocate a lot because of the fees and the efficiency of it. But it's something to really analyze, get your statements, and always take a good look at it. Some of the ones we look at, again, these are tremendous operations to build to create a lot of wealth outside the dealership, and also tie into the F&I training piece of it as well. Then in the summer, we kind of did our annual state and local tax update. That's one that's always been a big issue at the state and local taxes, as they always states and local municipalities are looking for ways to increase tax revenue. The biggest one out there affecting dealers we see a lot is the Wayfair sales tax case. A lot of states have joined into taking this position and are looking for sales tax dollars. And really what we see dealers run into this at when they sell parts on the internet across state lines. Could really trigger sales tax liabilities, and the tracking of it could be an administrative nightmare. So make sure if you're selling parts on the internet across state lines, that you're really out in front of this one. You don't want to surprise 3 or 4 years down the road by a state looking for sales tax dollars that you should have collected. It's very, very difficult, not impossible, to go collect those dollars afterwards. Same with sales and use tax considerations as well. That's why it's kind of covered in there. But that's the use tax is a sister tax of sales tax, i.e., if somebody who's supposed to be charging you sales tax doesn't, you are responsible for submitting what they call use tax. In the state of Ohio, sometimes such as landscaping or snow removal, some of that stuff, things like that, where people are supposed to be charging you sales tax. You really should be charging, they don't charge it to you. You're actually responsible for reporting use tax. We see a lot of this, more of it, the more bigger dollar items occur in the service shop, looking at shop supplies, jobbers, and stuff like that, to make sure you're really, if you got some big exposure there. There are programs that a lot of states have if you haven't been filing use tax. I recommend always filing use tax returns with zeros on your if you don't have it, because it gets you off the non-compliance list. Because there are a list out there the different states have of who's filing use tax returns and who's not. If you're not, you're probably eventually get a visit from somebody asking about it. Again, different nexus issues. All these taxes all have different nexus issues. So if you're interacting with other states, especially dealerships on state lines or near other states, across the states, make sure you have an understanding of the taxing in those states. A lot of them have reciprocity, but some of them don't, and just make sure you understand that. Ohio has a gross receipts tax, for instance, which is gross receipts. Michigan has something similar but different. So just give you a couple of examples, where you pay a tax on the gross receipt, and there's intricacies there between the gross cat tax. For those of you in the state of Ohio, the dealer trades, for instance, if it's depending on what that dealer trade is for, it could have subject to cat tax, subject to not. Incentive programs for the manufacturer could be subject to cat tax, some are not. So make sure you understand those programs. We used to put a template out, but the programs have got so varied, and folks not paying attention to the programs end up filling it out incorrectly, because some of these programs have different things that could make it to trigger cat tax. One of the ones, unclaimed funds rules. This is the one that gets missed a lot, I see. This is when you have checks written to individuals, not businesses, individuals that are never cashed. A lot of states have this, where you have to submit it to the state, to the rightful owner of that check gets to claim it. So it's something to be careful of, especially about old outstanding checks on your bank reconciliations and stuff to individuals. You really want to make sure you follow up on those. Again, last but not least, is if you're in a new area, moving to a city, moving into a new state, make sure you look for incentives. A lot of states have incentives to bring jobs into their city, into their state, so make sure it's something you look at. Ohio has an incentive called Invest Ohio, which we helped some dealers when they had to invest into new facilities. We were able to get a tax credit for the state of Ohio for doing that. So don't overlook incentives. It's an important part, and sometimes there's some tax dollars out there that could be available to you. So something you would definitely want to consider. And then we dove into valuing your dealership. This is a question we get a lot of, and what's my dealership worth? And depends. And we think and how do we drive value into our dealership to make it worth more? And we did a webinar with our evaluation director, Mike Stover, who kind of went through all the different things that drive value into a dealership, some key considerations to help make your dealership stronger. It's really a drive. You look at a dealership, and then at the end of the day, any business is worth the discounted cash flows of the business, or the ability to make that cash. So to franchise dealers on this webinar, it could be the brands, the highline brands versus domestic versus some import brands. Those definitely drive an intrinsic value, having been able to sell and service those vehicles, and also looking at the profitability and income statement of each dealership. A lot of times when we value dealerships, we have to what they call normalize earnings. Basically take the earnings, take the non-discretionary discretionary expenses out to adjust to get a true net earnings number, which drives the dealership. And then again, there's different uses for valuations. We got into that. Sometimes it's for estate and gift tax. You're going to look at it, and there's things called minority discounts and marketability discounts that get looked at as well to drive the value. If the purposes of the valuations is for a buy-sell agreement or to sell the dealership or do another transaction with the dealership, you're going to look at different drivers and use different discount rates. So there's different things going to value. It's simply not saying it's 4 or 5 times. Sometimes we see the Kerrigan report or the Hague report, and it's just a multiple of earnings. But also look at if you're using it for different things such as estate and gift taxes and things like that. Like I said, there's discounts and marketability discounts to look at as well, or to take consideration. So really understanding why you need the dealership. But we always say if you're 3 to 5 years away from doing something with your dealership, you really want to do some housekeeping on it. That's the point to start making sure your income statement's clean. Be careful of the discretionary expenses that's flowing through the dealership, to identify them and be able to document them. So when you get the valuation done, you go to sell the dealership, you don't get a discount or dinged on it because your income's not where it should be at and stuff. And then we did a segment this year on F&I compliance. This F&I as the new car margins get squeezed and we continue to see compression, F&I has become a bigger part of front end gross. So having that front end, the front end gross, F&I is becoming, like I said, is more of a component of it, and it needs to be a strong piece of the dealership. Having said that, you need compliance. This is one that's being targeted by the Consumer Protection Act people, and we're seeing exams. This is one that can get you in trouble. As much as it can make you money, it can cost you a lot of money if you're reckless in this area. So this is an area that you want to make sure you're on top of. And some of the stuff and you're dealing with you're dealing with a lot of personal information, Social Security numbers, and intimate numbers, and especially with the cyber attacks out there, you have to have things tied down in this area. That's why we talked about having a hall monitor, someone who's kind of oversees this for a quality control kind of perspective, make sure things are in the file, things are signed off, have proper controls over it. Obviously, we advocate the red flag guidelines, the safeguards rules. Be aware of what adverse action notices are. Risk-based pricing is always something that's under fire a little bit now, but you make sure it's documented. And also you protecting the warranty and the Magnuson-Moss Act provisions as well. These are all things that you want to make sure that you're on top of and have tied down and documented properly. So that's some of the stuff we talked about and just to be aware of in doing your F&I compliance. And again, I point you to the web. There's a lot of good information in the webinar that's on our website in this area. Then last month, we kind of talked about and kind of refresh our last month's webinar was on year-end tax planning and year-end accounting planning. And this is an area we kind of update every year as more of a memory jogger. And again, we always break it out in 3 different areas between tax planning strategies, accounting, and housekeeping cleanup ideas, and year-end compliance reporting. So this is an area we'll kind of do a flyover again, just real quick. This is time to get your schedules cleaned up, get your LIFO estimates booked, review your prepaids, start getting ready for year-end adjustments, and year-end to kind of get your fixed assets cleaned up. And this will really overall doing some housekeeping on the accounting side. This will help you drive some tax projections and figuring out if you need estimated tax payments, additional withholdings through payroll, that sort of thing. And this is where you want to get realistic also on getting your accruals tied down between write-downs on demos and used cars, tie down your interest on your, true up your real estate tax accruals, your tax accruals, get the bonuses accrued in there properly. So this is really an overall time to go through your trial balance before year end and start tying things down. Last year we struggled with the new tax act. There's a lot of new stuff came out. It was one of the sloppier tax laws in my career, at least I've seen. Didn't start getting regulations out even during the tax filing season in February on things. But there's a lot of things to keep in mind as you're going through that. The bonus depreciation rules are still out there. There's been some new regs issued here in September. Give some relief for the dealerships which were kind of limited on bonus depreciation. So make sure you're on top of that. You still have the Section 179, which is the expensing of fixed assets up to $1 million on the first $2.5 million of additions. The definition expanded significantly. Make sure you've looked at this qualified business income deduction, which is a 20% reduction for the pass-through entities. If you're a pass-through entity, meaning you're an S corporation or an LLC taxed as a partnership, you qualify for this 20% reduction of pass-through income, which kind of you want to strategize between, what goes through on a W-2 for you and what goes through income on a K-1 for you. So something to really keep in front of you. Also, you got to make sure the non-deductibility of entertainment expenses. Again, a definition we talked about there is if you go to a sporting event, the tickets, the seat license is probably not deductible anymore, but the food and beverages probably would be deductible. So make sure you're segregating that stuff out, not losing deductions. A lot of times I see training expenses and things like that, where meals are brought in, it's put in travel and entertainment. And, you know, make sure if it's training, it's separate segregated. It's just, this could become a big number for you. So just kind of make sure if you're doing things like that, you're segregating those out properly. On the individual side, you get the cost segregation studies are still out there in new construction, which with the bonus depreciation rules in the new regs could be a significant tax deduction for you. We always still recommend the cash balance, like a cash balance plan, or some supercharged retirement plans if they make sense to take care of, especially in this tight job market. It's a good retention tool, but also gearing those supercharged plans to get some significant deductions, especially for dealer principals and top management. Things like a cash balance plan or other profit sharing plans. Also, don't overlook the interest in advertising assistance on new vehicles for the franchise dealers on this call. That's always important. Again, LIFO, we expect some inflation on the vehicles this year. It's been I think it's hard. We expect some inflation. I don't think it's going to be a great year for that, but there is some inflation. So LIFO, should be some LIFO deductions this year. Make sure you're on top of the water in your used car inventory reports and capturing that at year end. So you know what water you have in your vehicles and looking for lower cost or market deductions there. And then on the individual side, I hit a couple points on the individual side to make sure we have the supercharged standard deduction now, $24,000. If you're in a state like Ohio where you pay heavy real estate taxes and state income taxes, that whole state and local tax deduction is limited to $10,000. So a lot of people got caught off guard by this last year. Something to be aware of, especially high income earners, they're going to lose a lot of deductions with that limitation in their personal return. Hopefully it's offset by lower tax rates, etc. But just be aware of that out there. Same with contributions. If you're not $24,000 standard deduction now, one of the strategies is actually grouping these contributions into a year, or using donor advised funds, or some of the strategies we've been implementing. So these are some of the considerations as you head into year end on the tax planning side. Just real quick, going over some of the tax compliance reporting issues. This again, we're just kind of recapping from last year. Demos. Make sure you're including it as a compliance fringe on the W-2s. The employer, the health insurance reporting and HSA contributions on the W-2s. W-9s for 1099 reporting, get those taken care of. Make sure the 8300s review those, make sure those are in compliance. Again, we talked about tracking the mills entertainment, sales and use tax on purchases, tracking sales out of state. Make sure you're on top of that if you're selling parts across the internet in other states. Again, also Ohio cat tax, tracking out of state sales on cat tax. And make sure on the cat tax, one other thing we see a lot about, I mentioned earlier, is if you have multiple entities, make sure that $1 million exemption is only get $1 million exemption. So if you have 3 different little entities out there, it's not $1 million for each of those exemptions on cat tax. We've seen that a couple times this year already. So that was kind of our year in review. A lot of stuff I know I kind of flew through pretty quickly, but it was just really the takeaways. And and I really encourage you to go back to the Brady Ware Dealership Advisors website. All those webinars are out there and the decks. And if you have any questions, my contact information is up there. Email me or call me, and I look forward to talking and seeing everyone in the new year in 2020. Thank you.